So welcome back to Chapter 16, Investing for the Future. As I said, I absolutely love doing stuff related to investments, and so I'm going to do some additional information for you and provide you some examples and share kind of an embarrassing thing for me. So if I were you, I would write this stuff down. So the first thing, there is this thing called the 70-20-10 rule. And what the 70-20-10 rule says is that you should save at least 20% of your net pay every check. And remember, net pay is your gross pay that you earn less all the deductions for taxes and other things. So net pay, 20%, save it. Have at least 3 to 6 months saved. And then you should invest at least 10% of your net pay because you're spending up to 70% for your fixed and variable expenses. So all your bills, your rent, your utilities, your phone, your food, etc. So the 70-20-10 rule. We had the rule of 72 about doubling money in this chapter, and now we have this one, which is a really important rule too, the 70-20-10 rule. All your life, percentages, what you should do. So just as a reminder, why do we invest? It helps us beat inflation, so we want to invest in stocks, bonds, mutual funds, ETFs, real estate, futures, options, whatever the case may be, and try to get a higher return on those investments than inflation is. That's how we will start to really build wealth, and when we build wealth, we are happy, fun, and challenging to do investing. Here's some other videos if you would like to look at them, that you're interested in them, but don't have to watch them for sure. So if you want to get back into the PowerPoint, you can. So I want to talk about how does stock work for an investor. So let's say that you buy 1,200 shares of stock at $1.54, and then 10 years later you sell all those shares for $2.96. It's asking how much do you gain. So let's first look at when we purchased them. So we purchased 1,200 at that price. We paid $1,848. Then we sold them at $2.96. So we had 1,200 shares. We sold them at $2.96. That's $35.52. That's our sales proceeds. Our proceeds are money we brought in. So to answer the question about how much did we gain, we take our proceeds minus our cost, and that's $1,744 or $704 gain or profit, whichever way you want to look. You could also just take the difference, 296 minus 154 times 1,200 shares, and you'd get the same answer. So that's a really nice gain. You only put in 1,800 and you got 1,700 10 years later. That's pretty impressive. You nearly doubled it. So it says if you spent $200 on a stock that costs $8.25 per share, how many shares would you have? So just another way of trying to look at this. So if you spent $200, they cost $8.25, we'd divide them and we would get 24.2 shares. This is known as a fractional share, so you are able to get fractions of shares, not full shares, so keep that in mind. So now let's just look at Disney stock, and let's just say that last year your parents gave you 5 shares of that stock for your birthday, and each share costs them $103.85. So if you take 5 times 103.85, you'd get $519.25. So they spent that, and that's the gift they gave you. Nice gift. And then you decide you want to sell those 5 shares today. How much will you get? So this is the date when we had done it that I had this share price, but it was 141.23 that day. And so your 5 shares times that, you would get $706.15. Again, you spent nothing. They spent that. You didn't. So you would have made $706. But I want to show you this Disney stock quote real quick. So let me do that. I think I have it pulled up here that I just clicked a few minutes ago. So this is Disney today, and again we're having some issues because of COVID, so it is down to 105.78. I want to show you how to kind of look at stock quotes. They all look differently, and I have a video in the next slide that I'm going to hopefully play or have you do it that explains things probably more thoroughly. But the Standard & Poor's 500, that is the biggest 500 stocks and how they're performing. So they're down 59 bucks today, those 500 shares. The Dow Industrials 30 is the top 30 shares, and the top companies, you know, the Walmarts and Amazons and energy kind of companies that are part of the Dow 30 are really not doing so great today. And then this is the whole NASDAQ, not the New York Stock Exchange, but the NASDAQ and how it's performing today. So you can see the market is down a bit. Then you have just the Disney shares. So this is its stock ticker symbol. So they always have ticker symbol so that you can look it up by that. It's just an abbreviation of the company's name. So like Eli Lilly is LLY. Disney is DIS. So they are trading at 105.92. It's down 2.23 for the day, so you can see kind of what the current trading is happening at right now. And it told you when the market opened, and then as you go down, there's lots of charts you can evaluate, but you're going to almost always see a stock quote that has this kind of look, and it may have a few different things here, but here's what I'd want you to know. In that video we'll talk about the previous close is what Disney stock closed at yesterday. So it closed at 108.15. It opened this morning's trading then at 106.36, and again I'm kind of looking up here. Yeah, it's down trading right now. And then the bid price versus the ask. This is always hard to keep track of. Bid is what I sell stock at. So if I was going to sell Disney shares, I would sell them at this bid price. If I were buying, I would be buying at the ask price with the broker. And this is the range it's been trading today so far, the range it's been trading all year, or the last 52 weeks, not just this year. This is how many shares or volume it is, and the average. And then the market cap, which is an interesting number. It takes the number of shares that they have outstanding, shares of stock, times the market price or the share price, and that's how much that company is worth. So they're worth $190.7 billion. A beta, if you want to find out more about it, certainly get on YouTube and find some videos, but beta just kind of talks about the volatility of the stock, and a beta of 1.1 is pretty solid. So they're not an incredibly volatile, moving all over the place, risky kind of stock. They're stable. The PE ratio is the price to earnings ratio, and this is saying that for how much they have in net income or earnings in the year, that you're paying 17 times in price. So the price you're paying for the stock versus the earnings. That's how you calculate that. The earnings per share is saying what is their income for every share of stock they have out there. So for every share that's held, they're making almost $6 per share. And then the most important for a lot of investors is this dividend yield, which is saying a 1.5% return on each share that you have. So just by owning the stock, you're getting 1.57 in dividends per year, typically. So that's what a stock quote looks like. And since I went that much into detail with you, I don't know that I'm going to play this video now, but if you would like further information on how to read a stock quote, this is a good video where the guy walks you through kind of what I just did in probably more detail than I did. So I want to just end with this what could have been story. And this one is kind of hurtful to me because I blew it. But it says S could have decided to spend $500 on Netflix stock around 15 years ago. And if she had held on to all of her stock, how much would she have today? What would be the value of how much I had today? So I'm going to try not to cry here as I do this. So Netflix share price back on May 7th of 2003. Some of you may not have even been alive yet. It was $1.69 per share for a share of Netflix. And $500, if I had just put $500 in, I would have gotten 295 shares. So, let's see if this opens up relatively quickly. Netflix stock split history. So in 2004, they did a 2-for-1 stock split, which means that for every share that you own, you would get 2 shares. Okay, so that's how that works, a stock split. So for every one I had, they would have given me 2 shares. So I had 295, and those would double then. And then in July of 2015, they did a 7-for-1. So for every one that I held, I would get 7 shares of stock. Okay, so that's how a stock split works. So I wanted you to see that. So that means that in 24, my shares doubled from 295 to 590. And when that happens again, they double the shares and then divide the price by 2, which doesn't affect me. I only care what's trading. And then in July 2015, when they did the 7-for-1 stock split, I had 590 shares. Then I would have had 4,130 shares in 2015. And at the date last trimester, this is what it was was 4,130 shares that I own would be at this price, which means I would have had $1,476,103 if I had only invested $500. So do I kick myself when things like that happen? With Netflix, if I'd have gotten in it early, I for sure would have had $1 million pretty easily. If I had done that with Amazon, would have done that pretty easily. But it's hard to know when those things are going to happen. And let me just try to feel better about myself slightly. Oops, I can't. I'll have to go in later and look at that. And that makes me just a little more sad as I look, because today it's trading at 423.93. So 423.93. So that's telling me that if I had 4,130 shares, I'm just going to do it for fun. 4,130 times what it's trading at, 423.93. I would have $1,750,830.90 right now. So obviously you can get wealthy pretty easily on a $500 investment had I done that.